Joining us now in the studios is Hemang Jani, Senior Vice President at Sharekhan, to help us understand what's going on with the market. Hemang, thank you so much for spending time with us on a week like this. Now, we keep talking about the fact that a long-term retail investor should buy low and sell high. So, for example, someone who maybe bought in 2001 after the September 11th attack, so someone who bought in 2004 or 2008 again, they've made handsome profits over the years. Where we're seeing the market today, is this one of those opportunities, or do you think this is a time when the retail investor should just stay away?
Well, clearly, as I see, there is a lot of pessimism around, and since last 3 years, equity prices have practically not gone anywhere. It becomes difficult to convince somebody to put money into equity. But that doesn't mean that the opportunity doesn't exist in equity investment. As you said very rightly, in the last about 10 to 15 years, whenever there are such occasions and people have invested money into equity, it has generated exceptionally good returns of anywhere from 20 to 50% compounded annually. And today we are seeing that there is a lot of pessimism. Valuations are at about 13 times for A group companies. For mid-cap stocks, they are quoting below book value. They are somewhere in the range of about 5 to 6 to 7 PE. So a company which is available at 7 PE, and if you are expecting it to grow at more than 10%, I think it makes sense to invest in that company.
Right. So you are saying this is an opportunity for retail investors today in India to consider picking up some stocks for their long-term portfolio?
Absolutely. I think that even vis-a-vis other asset classes, whether it is gold or real estate or debt, where people have been predominantly investing in, we believe that equity has a much better risk return because of the higher valuations. Yes, times are bad and it may go on for a while, but we've seen over the last 15-20 years that from these valuations, if you invest, the returns are going to be exceptionally good.
See, the other thing that has changed is what our definition of long-term is. Because it used to be 10 years. Now we're looking at people saying long-term is 3 years, long-term is 5 years. So for an investor who maybe goes out at this point and picks up some of these stocks, we'll get to what the stocks are in a little while. But if I pick up stocks at this point, what should be my horizon? And should I be prepared maybe for a 10% cut or a 5% cut from where we are right now?
From an investment point of view, if you invest now, you should have a horizon of at least about 2 to 3 years if you're a genuine investor. Because we've seen that because of the kind of noise which is around, because of the kind of volatility that you're seeing, sometimes people are not willing to take a view of more than 2 or 3 years. And then we blame it on the markets. But if we have really not done investment in a right way, our approach is not right of looking at 2 to 3 years, then there are going to be wrong decisions, and that doesn't give you the right kind of a return.
Alright, so you need to have a long-term horizon. You need to be prepared for a little bit of a cut from here because you might not have seen the bottom and we don't know where the bottom is. You talked about the fact that when you pick these stocks, they have to be the right stocks. So could you give us a quick checklist on what I should be looking for in the market right now?
One should go for either the mutual funds, which have a much better professionally managed team in place, or you could look at some of the exchange-traded funds, like you have Nifty Bs or Mid-Cap Bs, which have a wider basket, so the risk is much less. And if you really have time to look at the stocks and you can really study it and actively give time to that, then you could look at some of the top 50 or 100 companies. If you try to look at more number of companies, then it becomes difficult to track.
All right. I want to quickly ask you also about that big announcement we heard this week of the fuel price hike. It was a shocker. The market was pleasantly surprised, but the rest of the country was shocked. Tell us what this means for oil marketing companies that are bearing that subsidy. Is this enough for them? Does this now make those stocks attractive because it sends maybe a hint that the government is serious about removing that subsidy burden? Do you think this is positive enough?
See, for the market, this is definitely a positive step because for a long time there was no action coming out from the government, and finally, since we did see that action, market reacted positively to it. Talking of the companies, I don't think that this solves the problem to a great extent because the kind of subsidy burden that we are sitting on, only increasing petrol price solves only part of the problem. If you have to solve it, you have to look at things in total. You have to increase the diesel price, you have to increase the LPG price, and you need to come out with a fair formula for subsidy sharing. As long as you don't do that, the subsidy problem remains there.
The other group of stocks that get affected are auto stocks. I'm going to talk to you about auto stocks, but first I want to bring in the fact that you have recommended an auto stock to us this week. Hemang's first recommendation for this week is Maruti Suzuki. Take a look.
Automobile company Maruti Suzuki enjoys a 50% market share in India and is the market leader in the small car segment. But despite its clear leadership position, the company has been facing external pressures that threaten to eat into its profits. The latest petrol price hike will bring down the demand for petrol vehicles, and this will in turn hurt sales of Maruti. Also, the company is finding it difficult to meet the demand for diesel vehicles in spite of its tie-up with Fiat. This has already started impacting sales, which grew a mere 3% in the month of April. The other risk Maruti faces is the weakening rupee. The company procures a large chunk of its raw materials from Japan, and this cost will continue to rise till the currency appreciates significantly. Because of this, several market watchers have reduced their earnings estimate on the company. Now, even though the recent rate cut will help Maruti, the fuel price hike could accelerate short-term inflation, which will force the RBI to tighten rates once again. With higher interest rates, Maruti's sales are bound to take a hit.
Alright, so Maruti ended the week at 1118. It's down about 100 rupees over the last 2 weeks. I want to understand your thoughts here. 65% of Maruti's sales come from petrol cars. They're entry-level petrol cars. This is exactly the segment that will be hit by that rise in petrol prices. There'll be more of a demand for diesel. They're having some trouble with their diesel engine production as well. So tell us, at a time like this, on this week, why Maruti Suzuki?
One can't be really basing their investment on the basis of what has happened in the last 1 week. The petrol prices may not remain at this level for a very long period of time, whereas the Maruti stock has corrected in the last about 2 months by more than about 15%. And we feel that going forward, about 50% of the sales will come from diesel vehicles, where the growth is going to be much higher, and some of the issues regarding the capacity of the diesel, etc., plus the kind of product range that they could look at in the form of CNG and alternative tools would be much bigger in terms of growth potential.
But it is a stock that depends on a lot of macroeconomic factors. It's going to need interest rates to come down for people to borrow more and buy more cars. It's going to need the rupee to strengthen a little more because it brings in a lot of components from Japan, and that's going to cost them more. So it's a play on a lot of things. How soon do you expect this stock to start showing a turnaround?
The fact that interest rates are on the way down, we have seen 50 basis point cut, and over the next probably 1 to 1.5 years, you will see another 50 to 100 basis point cut, which would make these cars available to a lot of people. Also, one has to keep in mind that a smaller car, the average efficiency is much higher at about 20-25. So it doesn't pinch you so much. If you are spending, let's say, 1,000 rupees per month on the petrol, and if your salary is 50,000, then it is just a couple of percentage of that. So it doesn't affect you as much. So from that perspective, we think that there's not going to be much of an impact on the growth.
And what's your target for the Maruti stock at this moment?
We're looking at a target price of about 1,400 in the next 1 year's time.
Alright, a target price of 1,400 on Maruti. That's the first recommendation that Hemang has brought us on a week like this. He suggests we look at Maruti Suzuki as a good investment option. We have a question, in fact, that's come in for Pramod. He wants to know, as a long-term investor, and he wants to invest for more than 10 years, which is always pleasant to hear. He wants to pick some auto stocks, and he wants you to help him choose between Hero Motors and Bajaj Motors in the two-wheeler segment, M&M and Tata Motors in the four-wheeler segment, and Bosch and Exide in the auto ancillaries. So if you were to pick 3 out of these, which ones would you prefer he get into at this point?
Well, I think between Hero Honda Motors and Bajaj Auto, I believe that Bajaj Auto is a relatively better place, both in terms of valuations and the fact that they have focused on the niche segment, where the relative competition is less and the margins are higher, plus company has enough cash to carry out its operations. So I feel that Bajaj Auto is relatively better placed. The other stocks, I think between Tata Motors and Mahindra, Tata Motors, from a dividend yield perspective, is looking far more attractive. Plus, they have been able to do exceptionally well in their global business. JLR is doing exceptionally well. So I think, from a longer term perspective, definitely Tata Motor has a much better potential.
If you're looking at 10 years.
Absolutely.
And between Bosch and Exide, which one would you prefer?
Between Bosch and Exide, I definitely will go for Bosch because it is much stronger brand, much better stability in earnings. Exide has to face with a lot of volatility in the commodity prices, and the auto sector itself is quite volatile. Whereas Bosch, the kind of product range it has, there is a far more stability, and the return on equity for Bosch is much higher than Exide. So I would definitely go for Bosch.
We move on now to Hemang's second stock pick. We're talking about Bank of Baroda. Take a look.
Established in 1908, Bank of Baroda now has almost 4,000 branches in India and abroad. The company posted a 17% jump in fourth quarter profits, boosted by a large tax refund of 425 crore rupees. Net interest income rose 7% for the quarter, but interest margins fell by 49 basis points due to higher cost of deposits. The bank's biggest risk right now is its asset quality. Non-performing loans grew by 19 basis points, and the bank also set aside a provision of 340 crore rupees. Restructured loan book for the quarter grew almost 52% sequentially, especially due to the bank's exposure to the aviation sector. The stock has fallen almost 24% since February this year.
Alright, so that was Bank of Baroda, ended the week at 672, fairly close to its 52-week low of 615. At this point, given that the whole banking pack has taken a beating, why does Bank of Baroda make your list?
We feel that some of the A group PSU banking stocks which have corrected 25%, they are available at a price to book of 1, which is extremely attractive, and most of the concerns that people have are priced in, and we are looking at an overall growth of about 18 to 20%. So we believe that this correction has provided a good opportunity for investors.
And there was some concern when the company announced its results the last time that the NPAs or the asset quality caused some concern on the market. The stock was down about 3% on that particular day. Do you think in the long term, for a long-term investor, that should be reason for concern?
I don't think so, because when you look at the overall asset quality, it doesn't look too bad, though quarter we had seen some slippages. We feel that in the overall scheme of things, NPA of about 2 to 2.25% in a challenging environment is manageable, and overall growth expectations that we have are about 20 to 22%. So I don't think one should get too much perturbed about that.
Alright, and for an investor who gets in at this point and invests right now, what expectations can he have for the next 1 year?
I think over the next 1 year, one could expect a upside of about 30% from current levels, because banking is a high beta sector. And over the next 3 to 4 years, one could expect a gain of about 18 to 20%.
It's time for us to quickly answer some questions that you sent in during the week. Arjun has 200 shares of Indraprastha Gas, which he bought at 244 rupees. He wants to know, is it a good time to average out that stock at this point, 500 more shares to his portfolio?
I definitely think so, but this regulatory order which came in, the hearing is going to be on in the month of May. So till we have that clarity, the stock may remain a little dull. But yes, from an investment point of view, because of the fact that the stock has gone down by 40%, looks attractive to me, and finally I'm sure that some solution to this issue would be found. So I definitely think one should add.
Alright, and if he's buying 500 shares, would you recommend he break it up and not do it all on one day?
It could be done in a staggered way over the next probably a month or so, so that the average price is better.
Alright, so stagger that investment, but it does make sense to average it out. Ravi has written in, GSK Pharma, he wants to buy into that stock, and he wants to know, is it a good stock to add to my portfolio in the long term?
Definitely yes. I think it is one of the best MNC pharma plays that we have. Even from a dividend perspective, it is looking quite good, and some of these MNC companies may go for delisting, as we've seen it happen in case of other companies. So that could open up another trigger for him, and the company is growing at about 20-25%, very high margin, very good quality of corporate governance. So I am definitely for it.